Candlestick charts are a powerful tool for traders. They originated in Japan centuries ago. Rice merchants used them to track the market price of rice. Today, traders all over the world use them to understand the price movements of stocks, currencies, and other assets. Each candlestick tells a story about the price during a specific time period, like 1 day or 1 hour. It shows the opening price, the closing price, the highest price, and the lowest price. The color and shape of the candlestick give us important clues about whether buyers or sellers were in control. Understanding these clues is the first step to making better trading decisions. The body of the candlestick is the wide part. It shows the difference between the opening and closing price. If the body is green or white, it usually means the price closed higher than it opened. This is a sign of strength, showing that buyers were pushing the price up. If the body is red or black, it means the price closed lower than it opened. This is a sign of weakness, showing that sellers were pushing the price down. The thin lines above and below the body are called wicks or shadows. These wicks show the highest and lowest prices reached during that time. Long wicks can tell us about market volatility and indecision. Why are these patterns so important? They are a form of technical analysis. This means we are studying past price movements to predict future ones. Candlestick patterns are visual representations of market psychology. They show the battle between buyers, or bulls, and sellers, or bears, in a way that is easy to see. When certain patterns appear on a chart, they can signal that the current trend might be about to reverse or continue. For experienced traders, these signals are like a roadmap, helping them to navigate the ups and downs of the market with more confidence and a clearer strategy. Learning to read these patterns is like learning a new language. At first, the shapes and colors might seem confusing, but with practice, they start to make sense. Each pattern has a name and a meaning. Some patterns are simple, involving just one candlestick. Others are more complex and involve 2 or 3 candlesticks together. By combining these patterns with other trading tools, traders can build a strong system for analyzing the market. This knowledge helps them decide when to enter a trade, when to exit, and how to manage their risk effectively. It is a fundamental skill for anyone serious about trading. Bullish patterns are signals that suggest a price might be about to go up. These patterns often appear at the end of a downtrend, indicating that buyers are starting to take control from sellers. One of the most famous bullish patterns is the hammer. A hammer has a short body at the top and a long lower wick. It looks like a hammer. The long lower wick shows that sellers tried to push the price much lower, but buyers stepped in and pushed it all the way back up near the opening price. This shows strong buying pressure and can signal a potential bottom in the market. Another common bullish pattern is the bullish engulfing pattern. This pattern involves 2 candlesticks. The first is a small red candle, followed by a larger green candle that completely engulfs the body of the first one. This pattern shows a dramatic shift in market sentiment. After a period of selling, which is the red candle, buyers came in with great force, shown by the large green candle, and completely overwhelmed the sellers. It's a very strong signal that the downtrend may be over, and a new uptrend could be starting. Traders often see this as a clear opportunity to consider buying. The morning star is a 3-candle bullish reversal pattern. It starts with a long red candle during a downtrend. This is followed by a small-bodied candle, which can be red or green, that gaps down, showing continued selling pressure, but also some indecision. The third candle is a long green candle that closes well into the body of the first red candle. This confirmation candle shows that buyers have taken firm control. The morning star is like the sun rising after a dark night, signaling that brighter days or higher prices may be ahead for the asset. These bullish patterns are most reliable when they appear after a significant price decline. Their location on the chart is very important. A hammer at the bottom of a long downtrend is a much stronger signal than one that appears in the middle of a sideways market. Traders always look for confirmation. For example, after seeing a bullish pattern, they might wait for the next candle to also close higher before entering a trade. This extra step helps to confirm that the buying momentum is real and reduces the chance of a false signal. It is this careful analysis that separates successful traders from the rest. Bearish patterns are the opposite of bullish ones. They signal that a price might be about to go down. These patterns typically form at the end of an uptrend, suggesting that sellers are starting to gain power over buyers. A classic bearish pattern is the hanging man. It looks just like a hammer, but appears at the top of an uptrend. It has a small body at the top and a long lower wick. This pattern suggests that even though buyers managed to push the price back up to close near the open, there was significant selling pressure during the session. It is a warning sign that the uptrend could be losing its strength. The bearish engulfing pattern is a strong reversal signal. It is a two-candle pattern that occurs during an uptrend. The first candle is a green candle, showing buying momentum. The second candle is a large red candle whose body completely engulfs the body of the previous green candle. This powerful pattern shows that sellers have stepped in and decisively taken control from the buyers. The mood of the market has shifted from positive to negative very quickly. For traders, this is often a clear signal to consider selling their position or even opening a short position to profit from the expected price drop. The evening star is the bearish counterpart to the morning star. It is a three-candle pattern that signals a potential top. The pattern starts with a long green candle in an uptrend. This is followed by a small-bodied candle, red or green, that gaps up, showing that the buying momentum is fading. The third candle is a long red candle that closes deep into the body of the first green candle. This final candle confirms that sellers have seized control. The evening star suggests that the sun is setting on the uptrend, and a period of darkness or lower prices may be about to begin. Just like with bullish patterns, the context is crucial for bearish signals. A bearish engulfing pattern at a major resistance level after a long rally is far more significant than one appearing randomly. Traders always seek confirmation before acting on a bearish signal. They might wait to see if the next candle also closes lower, which would validate the selling pressure indicated by the pattern. This patient and disciplined approach helps to filter out weak signals and improves the quality of trading decisions. These patterns provide valuable warnings that help traders protect their profits and avoid losses. Traders trust candlestick patterns because they are a time-tested method of visualizing supply and demand in the market. These patterns are not magic. They are graphic representations of human psychology and behavior. Greed and fear are powerful emotions that drive market movements, and candlesticks capture these emotions in a simple visual format. When many traders see the same pattern, such as a bearish engulfing, and react to it in the same way, by selling, their collective actions can turn the signal into a self-fulfilling prophecy. This is why these patterns have remained relevant for centuries. The reliability of candlestick patterns comes from the story they tell about the battle between bulls and bears. A long green candle shows that bulls are firmly in control. A long red candle shows that bears are dominant. Patterns with long wicks, like the hammer or hanging man, show that there was a significant struggle, but one side eventually won out, hinting at a potential change in direction. This visual clarity is much easier to interpret than just looking at a simple line chart of closing prices. It provides a deeper layer of information about what happened within a specific trading period, which is invaluable for making informed decisions. Of course, no single tool is perfect, and candlestick patterns should not be used in isolation. Smart traders combine them with other forms of analysis. For instance, they might use trend lines, moving averages, or volume indicators to confirm what the candlestick patterns are suggesting. If a bullish engulfing pattern appears at a strong support level and is accompanied by a surge in trading volume, the signal becomes much more powerful. Using multiple tools together creates a more robust trading strategy and increases the probability of success by filtering out false signals and confirming true market shifts. To summarize for beginners, remember these key signals. For bullish signs, where prices may go up, look for the hammer, the bullish engulfing pattern, and the morning star, especially after a downtrend. These show buyers are taking over. For bearish signs where prices may go down, look for the hanging man, the bearish engulfing pattern, and the evening star, especially after an uptrend. These show sellers are gaining control. Always consider the context of where the pattern appears and look for confirmation before making a trade. Mastering these basic patterns is a crucial first step on the path to becoming a proficient technical trader.